Director of Equities at BRICS, joins in now to talk about the market, which is trading at 5,300 plus. Anand, morning. Before you talk about the market, any thoughts on these toll kind of players and how you would like to value them, stocks like IRB or ITNL?
Well, the most logical way of valuing it is to make some assumptions on the basis of DCF. And, what you'd find is that at least in the case of IRB, for example, that the valuations more or less factor in most of the value that is there in the stock given the current contracts as well as some of the new contracts that are likely to happen. You also have to remember that these companies will be reasonably sensitive to interest rates because, as is prone to any kind of DCF valuation, as interest rates were to rise, you'll have the effect of it coming through fairly quickly. So long as, they remain high asset owning companies, obviously the returns are somewhat capped, and therefore investors should not be looking at, multi-bagger returns in the near term from these companies.
Anand, morning. You track the rupee with as much interest as you do the stock market. What have you made of the way it's been running, and would you be worried about spaces like IT?
Well, obviously it does affect IT, but I think to a large extent most IT companies are at least now beginning to factor that in. That doesn't mean that they can do much about it other than some hedging. But I think if you look at, for example, US Treasury 10-year yields, that's the best indication of what the rupee is likely to do. It's just gone up in the last week to 3.9, and you can almost kind of make a one-to-one correlation between that and the market that we are seeing currently. So, it was falling briefly for a period between Jan and Feb, and then it has started to rise again, and that's more or less been the direction of the market. So obviously the foreign fund flows will determine how far the rupee will go. For the moment, I think, the flow seems to be again away from US Treasury and therefore to some more risky assets.
Anand, markets at 2-year highs, threatening to or promising to break out of a long-standing multi-month range. Would you bet on more upside, or is this the phase where you'd be taking profits?
Well, right now the trend is positive, and usually when you have a breakout, holding a bunch of investors enters into the market. So, there is no particular urgency to exit the market. We have been arguing that, we are at the higher end of the trading range and in the valuation range, and I think we continue to hold that view. That said, the valuation is not an exact science, and there is no reason why we cannot witness yet another bubble. Therefore, be prepared for the bubble because that's where you make the most money. But that's where there is greatest likelihood of injury as well. So, right now I would imagine that the best way to do is to stay with the market and watch for any signs of reversion and be ready to move out of it.
You've come attendant with interest in sectors that haven't moved in a long time, Anand. For example, pharmaceuticals that you track. Is that a story worth looking at within the market?
Well, right now there is almost none of the frontline sectors have any valuation gap left. Obviously, interest in Indian pharma continues, especially now that the healthcare bill has been passed in the US, and therefore there is a greater hope of generic activity going into those markets. Obviously volume growth can continue to happen, but I don't see that there is any major theme that is there in pharma which can play out in a big way, which can change the dynamics of the company. The domestic pharma market has also started to grow reasonably robustly, and therefore, in the near term, actually, it's the domestic market which has been driving stock prices to a large extent. Also, I think M&A activity is likely to increase. More foreign players will actually be taking up stake in Indian markets. So there will be a reasonable amount of excitement. I don't necessarily think that there is anything that will change the economics of it dramatically in the next few months.
If you had to bet on a clutch of mid-cap pharma names now, Anand, which ones would you choose from A, the CRAMS players, B, the pure NCE kind of research players, or C, the generic players and the domestic formulation players? Because all of them seem to have been going up, but which one seems the most exciting in terms of an opportunity?
So as I said, if you keep the valuation aside, I think generics is obviously one place where there is reasonably long-term kind of growth potential. CRAMS is something which flatters to deceive. The story is quite good and there is no particular reason why they should not pan out. But so far we have not seen any delivery from any from the industry as a whole. I think we have one or two cases where companies have done reasonably well, but otherwise by and large as a trend it has failed to take off. So, as a contra play, maybe there is something that you would hope that one day it will. But from a pure business growth perspective, I think generics and domestic formulations are both reasonably exciting.
What do you do with the third leg of the rate sensitives though, Anand? I mean, you talked about the toll-based projects, but does infrastructure deserve a look in?
Well, from a point of view of need, I think absolutely. It, like many other things in India, we are under-invested in infrastructure. Whether it will make money for investors, completely different ballgame, because clearly when you are looking at long-term investments which require very heavy capital investments, rising interest rate scenario is not something that will make any near-term money. Also, you have to remember the risks in the projects are reasonably large, and so far we have not seen any major government effort to try and reduce risk. I think one of the key areas of infrastructure that one needs to look at is, for example, the judicial system, which has got nothing to do with the market, but which I think is now holding back the Indian economic growth in a very large way, and which is significantly under-debated.
What do you think will be the more likely outcome from earnings season, Anand? That the market sees a justification of where it's trading at, or do you think it might actually get tugged lower because there may be some slip-ups?
Broadly, I think the results will be quite good. I don't see any major sector. In fact, you may actually find a few surprises. Clearly, cement, for example, has done exceedingly well compared to analyst estimates. The prices have held up, as have the volumes. So clearly, I don't see any major sector that is likely to disappoint in terms of earnings. The issue really is in the extrapolation from here to the next year, because the extrapolation tends to be linear, whereas the reality is far from that. So I think, we are still not quite out of the woods in terms of the fears, but given that, we are supposedly one of the faster growing economies in the world compared to, most of the others, you might as well hang in there and, hope that the valuations will take care of themselves. The big fear I have is that the next year's earnings estimates are predicated to a large extent. Almost 30% of the growth is coming out of things like metals, and I'm a lot less sanguine about prospects of metals, though the near term in India at least, for example, steel seems to have run out of capacity and therefore has significant pricing power.
The view earlier, Anand, was that the market would correct sometime and significantly, maybe in the first half of the year, and then towards the end of the year, you see the market building up and maybe closing the year even with gains over last year. But the way it's moving now, is it also possible that we get a blowout now which takes us close to the old peak, and then you see a correction, not before that as was originally anticipated?
Quite possible, Udyan. I think, whenever we look at the future and whenever you hear anybody, including us, say that, 6 months out the view will change, it is just because it's far enough away that you can't hold us to it. So, we really have no crystal ball. Right now, as I said, the best thing you can do is trade with the market. And be aware that there are serious concerns still pending. I mean, I think, I've mentioned this before several times. Sovereign defaults is a big risk. Markets behaving as if Greece has been sorted out. If you look at the latest economist, their estimate is that you need 75 billion euros, not 25, that the market's attributing for just bailing out Greece alone. I don't think that kind of money exists if you look at all the countries that are lined up after Greece. So I think those issues remain. I think the commercial real estate in the US continues to haunt. I think it will be another area which will be a major area of concern. But, concerns are what drive markets up. So, right now stay with it.
Okay, Anand, thanks very much for your thoughts today.